Hi, this is our early global view for Tuesday, September 22nd, 2015. It's currently 7:45 a.m., coming to you a bit later than usual due to a minor technical problem we were fortunately able to address. And a very important day today because the equities are weakening once again, and that is putting a bit of a bid in the govies, but it is not weakening the U.S. dollar. Very interesting. So the question is, what does all this mean to the markets? And the answer is quite a bit weaker this morning so far, with the U.S. S&P 500 off 33 at 1930. Now what's interesting is the 1930 to upper 20s is one of the support levels on the December contract. However, the lead contract support is classically the historic congestion is more so down around the 1920 area, with the even bigger support around 1900 to a buffer with a buffer to 1895. And you can see what happened here, as we noted, of course, in Friday's update, and especially if you have not looked already, we had a discussion of the overall market psychology. That last week was no surprise out of Tuesday into Thursday afternoon. The FOMC friendly anticipation drove this market up to $60 higher on the week, only to see it flop back down on Friday with some slippage right back to 1950, essentially steady on the week as the post-Fed euphoria wore off. This was rather abrupt compared to previous examples of this, but then again, the background economic performance is weak, and the Fed highlighting that as a reason to stay accommodative was not very healthy for the equity markets. So even in spite of the down break from last Friday being exceeded at a couple points yesterday, even with the market closing back above 1960, unless this market was going to be above the lead contract level that was more important, up at 1968 to 70, then it really wasn't proving anything on the upside. And we'll have to see if it can even stabilize to get back above 1945 to 50 later this week, or if it heads down for those bigger, lower supports. Now, the one thing we can say is that on the indicators, where the hourly MACD ticked just up above the downside runaway band late yesterday, on today's opening it's going to be down again. So we're reestablishing not just the failure with the next level falling by the wayside as 1950 to 45 is violated, but also the reinvigoration of downward momentum on the indicators. And that pretty much does it for the short-term view of the S&P 500.